Hello and welcome to the Ashworth Wealth Weekly Market Update. I want to spend some time today talking about a topic that we have touched on many times in the last year or two, which is interest rates. Specifically, interest rate cuts and inverted yield curves are the two kind of major topics today. So the Fed met last week and they decided to reduce the number of expected rate cuts from 2024 from 3 down to just 1. Not unexpected. If they were going to do 3, they would have already needed to do 1, and they hadn't. So that's pretty standard information, what we were already kind of expecting to have happen. We'll, of course, hope for more good news on the inflation front here coming up so that we can get that 1 cut. But any additional cuts will most likely have to wait until 2025 at this point. What the high rates are currently pushing and have been for now 23 straight months is an inverted yield curve. So an inverted yield curve is where short-term treasury yields or yields on short-term treasury notes or bonds are higher than on long-term. This has historically been a harbinger for bad economic activity, specifically a recession. So oftentimes when you would see an inverted yield curve, the thinking was that a recession was right around the corner. However, in this particular case, we've now had 23 straight months of an inverted yield curve, which is very abnormal. Some people think that that's just business as usual and it's going to continue to stay this way, but that would be very, very unusual. If you take a look at the chart here, the average from January 2000 to January of 2009, you can see on the dark gray line, your 1-year treasury yield curve where your 1-year treasury yield, was at 3%, whereas if you went all the way out to 20 years, it was 4.5%, meaning you were rewarded for buying a longer term bond. If you take a look from 2009 to 2019, very similar curve, just a lower yield. So short term, you were all the way down in the 0.5% to 1% range. Longer term, maybe up in the neighborhood of 3% was the best that you were able to get. Right now, it's much more profitable to buy a shorter term bond than it is to buy a longer term bond. That's what an inverted yield curve is. As far as when that changes, well, it's probably not changing until the Fed lowers interest rates. That's when, once again, it's going to look more attractive to have a longer term bond. In the meantime, we've been keeping our clients, generally speaking, in shorter term treasuries and shorter term bonds, and we don't see any reason to change that in the near future. So right now, kind of what we're looking at is obviously for the Fed to only cut rates 1 time since they've come out and said that. But so far, the economy is holding very steady. We've had very few issues from an economic standpoint up to this point, which has been fortunate. So we'll hope that that continues. In the meantime, we will continue to diversify our portfolios, making sure that we're using bonds appropriately as part of the portfolio. Should you have any questions about inverted yield curves or rate cuts or anything else, please feel free to reach out. We're kind of in the summer months right now, so not doing quite as many reviews with our clients, but we're always happy to answer questions and schedule meetings as needed. So please feel free to share this with anybody that you would like. We do appreciate the opportunity that we have to work with each of you and hope that you find this information useful. Have a great rest of your week. Bye.